In this video, we're going to be looking at the area of candlestick analysis. A couple of objectives included in this video surround the areas of trying to read candlesticks, understanding candlesticks as a representation of sentiment, and the most important one, the interpretation of common candlestick patterns. What does this point specifically mean? Well, we'll discuss this further throughout this video, but I wanted to make a clear point that must always be remembered. When you have a simple sign from a candlestick pattern, whether it's bullish or bearish, the problem that many investors make, many traders make, is that they think that essentially means that will be the outcome. But it's not the case most of the time. We have to look at things in their context. So we look at the intrinsic indicator, and then we look at the extrinsic bias of what's going on with regards to the trend, moving averages. We've got a lot of videos that will help you in conjunction with this idea that we're going to be looking at today of candlestick analysis. So we're going to have a brief introduction to candlesticks. We've got a little bit of notes here, and I thought I'd walk you through them, save a little bit of time there. The best thing we should know first is that candlesticks are constructed using open, high, low, close data. That's OHLC data. It essentially means that there are 4 prices shown by each candlestick, and they are best thought of as a visualization of investor psychology. By showing levels of price reversal and rejection, candlesticks can plot the changing balance between the power of bulls and bears. There are some patterns that repeat throughout all markets and timeframes that can be used as an indication of future price direction. The patterns can consist of 1, 2, or multiple candlesticks. Firstly, though, it's important to know how to read candlesticks. A candlestick shows the behavior of a price over a specified duration. So one example here could be a daily candlestick showing the price behavior over the course of a day. When there was a net rise in price over a given period, the candlestick is likely to be white. In this case, we've only used white and black. White is for positive movements in price, and black is for negative movements. You'll commonly see things like red or green. But in this case, when there was a net rise in price over the period, the candlestick is white. If there is a decrease in price over the period, it is shown to be black. You don't have to use black and white. Many people use red and green. It's a default indicator on sites like TradingView and investing.com. You can use whatever colors you want, to be honest, as long as there is a clear differentiation between up and down candles. It is conventional, though, to use black and white or red and green. Let's walk you through, though. For any candle, the highest and lowest prices are shown by the thin vertical line. If we can get the highlight tool working, we'll show you. This is the lowest price, this is the highest price, and respectively too, here we've got the highest price and the lowest price. These can be called wicks, tails, or shadows. The thicker part of the candlestick, however, as shown by here, here, and here, that area, represents the real body, as we like to call it. For a white candle, the bottom of the real body is the open price. That's where the price opened at, and that is essentially the very first price of the period. The top of the white body, though, is the closing price for the period. If we go over to a black candle, the high and the low are still shown by the wicks, but the top of the real body is the opening price at the time, and the bottom is the price closing point. That's the bottom of the real body. The closing price is here below the opening price for black candles because there was a net decline over the period. So we're going to look over quite a few patterns, the first of which for today is called a Bullish Marubozu. This is a single candlestick pattern. It's a strong white candle. It opens at or very near to the low and closes at or very near to the high. It essentially shows that bulls were completely dominant during the period and were able to drive the price right up with very little resistance from bears. Bulls are essentially in control of the market, and there's a good chance that it will rise further. So if we look here, we've got an example of 2 bullish Marubozus. The first one kicks off the uptrend, And the second one kicks off a strong leg of the uptrend. This is a second leg of a continuous uptrend from around here to, we can say, the end of the period that we've been looking at. Both of these bullish Marubozus, though, showed that bulls were dominating the market and they were likely to push the price even higher. And this is what they did if we look closely. A bearish Marubozu, however, is the exact opposite of the bullish Marubozu. The large bearish candle opens at or near its high and closes at or near its low. Let's look here. Opens here, closes here. In this case, the bears were completely dominant, forcing price lower with bulls unable to resist the bearish pressure. So let's go to our next example. Just so you can see some bearish Marubozus in a real market environment, here are some occurring in a strong downward swing in the US dollar versus Japanese yen currency pair. It's clear here that the bears were in control during this swing. So if we look here, this has been where you've got a bearish Marubozu, and following that we have a subsequent fall in the valuation of this asset. We can see again a subsequent fall. That may be an indicator to be going short. The next one we're going to be looking at is called a Doji. This represents indecision in a market. It is intrinsically neutral. It closes on or close to the opening price, meaning it really has no real body. The wicks are unimportant here, though, in classifying a Doji. It is still a Doji whether it still has wicks or no wicks or whatever. It doesn't matter. The wicks may give some extra insight into the sentiment. For example, if a Doji has no upper wick and a very long lower wick, it's showing that the bears began by dominating the market, pushing the price down, but by the end, the bulls had fought back, let's just say, and driven price back up to the open. In that case, bullish market participants have more momentum, but a Doji is still broadly intrinsically neutral. Let's give an example. Here are some Dojis occurring at various points in an hourly chart of Apple. They show a lack of decisiveness among investors about where the price will go next. Now let's look. Around 8:30 p.m. we can see there was a Doji here. There was indecisiveness of the trend. We can see another one, indecisiveness of the trend. Another one, indecisiveness of the trend subsequently after. We're now going to look at a hammer. A hammer is a bullish reversal pattern. It has a small real body with a long lower wick. There is no upper wick, or a very small one at best. The color of the real body isn't actually that important. Black or white, the sentiment is the same. A white hammer, though, may be considered marginally more bullish because bulls were able to drive price above the open, but the difference is marginal at best. It shows a bullish recovery in that bears were initially in control by driving price down to form the wick, but then the bulls are able to recover by driving price back up to have a strong close. There is normally a willingness here to buy at those low levels, hence why the bulls are entering at the market there. It must occur, however, in an oversold market or after a significant decline in order to be classified as a hammer. Let's go to give an example now. So, here are two hammers occurring after a steep decline around prior support. It's showing bulls are entering the market at those levels. Price responds by reversing strongly to the upside. Let's look at the hammers closely again. We've got them happening here. We've got two hammers, and the price shows an area of support. We see a reversal to the upside. It's that simple. Now, let's look at the next pattern, which is called a hanging man. A hanging man might help us understand why the context of patterns is much more important, and something I'd stressed at the beginning of this video. This is because the hanging man takes exactly the same form as the hammer pattern. They are identical, yet the hammer is bullish and the hanging man is bearish. Why is that? That's because the difference is extrinsic. I almost made a mistake there. The difference is extrinsic. This formation is considered a hanging man only if it occurs after a strong advance in price or in an overbought market. then it is showing that bears are starting to get a foothold in the market by initially overpowering buying pressure to force price down to form the wick. There is a clear willingness to sell at those extremely high price levels. So these are some points just to summarize what we were talking about. And we'll go to an example now where we can see a hanging man pattern marking the end of a sharp advance in an hourly Apple chart. This is the shares of Apple, the US tech company that we're looking at. Sellers look to enter at this point, if we point out here, and we get a 9 successive bearish set of candles after that goes all the way from around $226 a share to roughly $217. If one were to go short on this hanging man candle, they would potentially be able to get a decent return without a lot of risk, maybe a stop above that point. It's really that simple. Again, a hanging man setup in this case though would be bearish, but the hammer setup is normally bullish. So now we're going to look at a shooting star. The shooting star is like a hanging man flipped upside down. So let's get an image here. We'll get a couple of notes too. It is like the hanging man, but flips upside down. The same with a hammer, but it's kind of upside down. It is a bearish pattern though. We must emphasize that. There is a long upper wick, a small real body, and no or very small lower wick. The body can either be black or white, it really doesn't matter, but it must occur after an advance. So it's showing that initially the bulls were dominating and continuing the uptrend, but bears started to enter at a large size. The bears just came through with the Trojan horse at the higher price levels and then pushed the price back down. So here's an example. Let's have a look. This is probably a great example to start introducing the concept of extrinsic bias. The intrinsic bias is the bullish or bearish bias that exists within a pattern. So let's give an example. A shooting star, in this case, is intrinsically bearish. So normally when you see that kind of thing happening, it's a bearish sign for you as an investor or a trader. The extrinsic bias, however, is the sentiment associated with where the pattern occurs. So that may be in relation to some significant overlay or price barrier, indicator readings, price targets, market cycles, sector rotations, etc. There are so many different things that could be classed as factors influencing an extrinsic bias. So when the extrinsic and intrinsic biases are in agreement with each other, a much stronger signal is generated. In this example, we have an intrinsically bearish shooting star, which is a stronger bearish signal because it occurs at just an important prior resistance level that is showing by this point extrinsically bearish, and there is a good chance that the market will fall from here, which it actually happens to do so. Let's show. This is the point where the shooting star occurred at a prior level of resistance, and it falls right back down. How surprising. Now, an inverted hammer. This is another pattern that we're going to be looking at. It's identical to the shooting star. However, it only occurs in oversold markets or after a significant decline. It's a bullish reversal pattern, and after a decline, it is showing willingness to buy from bulls because they were able to form the long upper wick, which we can see by here. Prices is struggling to hold at those lower levels, and so it's starting to get bought up. This is a bullish reversal pattern, we must remember. Let's give an example in context. Here's an example of an inverted hammer. This is intrinsically bullish, and it's occurring right at where the price tests the 200-day moving average in the S&P 500, as we can see by this graph we're using. Here, both intrinsic and extrinsic biases are in agreement, and we have a very strong response from price in the form of a strong bullish Marubozu, shown by this point. You can see a strong bullish Marubozu, a continuation of upwards movement. The trend isn't really clear at this point, but we can see that the short-term trend is up in this moment. We had that strong bullish Marubozu, and we had a subsequent substantial advance in price. The next pattern we're going to be looking at is called dark cloud cover. Now, Dark cloud cover is a bearish reversal pattern which consists of two candles. The first candle has to be reasonably sized, and it has to be a reasonably sized white candle. Whether it has wicks or not, though, is not important. The second candle, though, has to open with a gap up, which means it opens higher than the previous close. So it starts off bullish, but then bears flood the market and drive the price down to close below the midpoint of the previous candle. Once again, wicks in this case aren't important. So let's walk that through one more time. We've got the open price here. We've got the close here of the first candle. This could be a daily setup, could be a minute setup. It really doesn't matter. But in this case, we can see the first set of moves was up, or the first move in particular. The second move was down, but the price gapped up on open and then closed down below the midpoint of the first candlestick. That is when dark cloud cover is occurring, and that is normally a bearish reversal pattern. So let's get a graph up. We've got an example here of dark cloud cover reversal occurring, and that is when it coincided with a test of a descending trend line in Apple stock. So we've got the descending trend line here. Share price action is moving about everywhere, and it tests this trend line's resistance point. You've also got dark cloud cover occurring. You can see that the second candle closed below the midpoint of the first candle, which is a bearish pattern. You've got situations where you can coincide trend lines and the candlestick patterns together to give you a short bias where you would likely be trying to trade this particular stock. The next pattern of our candlestick analysis that we're going to be looking at is called a piercing line. Piercing lines are the opposite of dark cloud covers. It's a bullish reversal pattern. This time, though, the first candle is a reasonably sized black candle, which may or may not have wicks. The second candle opens up with a gap down, but closes above the midpoint of the first candle. Let's walk that through again, because this is quite a complicated one. Let's show it again. Price opens here on the first candle. Price closes here on the first candle. You got your highs and your lows, obviously. Then we've got a gap down here. Price goes from there to there. The gap down, the price closes up. This is a bullish reversal pattern purely because the close, you can see, was above the midpoint of the first candle. The reverse of dark cloud cover, a piercing line, is a positive indicator. So let's try and see if we've got an example here. This is a piercing line warning of a reversal after a steep decline, as we can see here, in Facebook's shares. As soon as this piercing line occurred, you would likely see a bullish signal, and as a technical reversal pattern, this is normally something that you would go long on. But once again, you have to put all your bits of analysis together and not just look off one pattern. Here's another pattern, a tweezers top. This is a bearish reversal pattern. It forms when the highs of two consecutive candles are the same in a rising market. It doesn't matter whether the highs are made by the open or close prices or the upper wick. As long as both have the same high, the resistance level has clearly been established, and we can expect to see a reversal. So let's see if we've got an example here for our tweezers top setup. We have a tweezers top here occurring in the daily pound against the Japanese yen market after a significant advance. So we've got the advance from here to there. Imagine an imaginary trend line just showing that we've had an advance, and then we have the tweezers top occurring and a short-term reversal. Those using margin could potentially get a trade here, and this is really as simple as it is. That is a bearish signal because we have the tweezers top. You can see at the top here, the top of the wick of these two candles seem to be a resistance point that the price fails to break out above. Time and time again, this happens across a lot of assets that you can chart yourself. But we can see there, it fails the second time, and the entire price action reverses there. So let's look at the reverse pattern, a tweezers bottom. A tweezers bottom is the opposite. Two consecutive candles have the same low, which can be formed by lower wicks or the bottom of the real bodies. support is clearly established here, and bulls can expect to take over and change things around a little bit. Let's see if we've got a diagram here. We've got an example showing the Tweezers Bottom occurring, and it accurately predicts a reversal in the daily prices of the Dow Jones. Notice the same support that was identified by the Tweezers Bottom here, by these two lows of the wicks, of the candles, the two wicksy, goodness me. As you can see here, we've got 2 points of lows, and then the price reverses. This happens to be an important area of support that is tested again a little bit later. That's interesting. You can see a double bottom being formed on the chart, the support held, and the market actually rallied after this. That is really interesting to see. Let's look at another pattern. This pattern is called a bearish engulfing. A bearish engulfing is like dark cloud cover that goes further. So it starts with a white candle, then the second candle opens with a gap up, but instead of just closing below the midpoint of the prior candle for an engulfing, it has to close below the previous real body, otherwise known as the previous open. The second candle's real body range totally engulfs the prior real body range. It clearly shows bears are asserting their dominance in the market, and they can be expected to push prices lower. So let's get an example here in our chart. Here is a bearish engulfing calling a top in the Russell 2000 index. You see the bearish engulfing occurs, the price falls accordingly. It's that simple. Let's go now to look at a bullish engulfing. This is the exact opposite of what we just mentioned before. The second candle is a strong white candle that engulfs the first. So even though the second candle begins by gapping down, by the close, bulls have erased all the losses from the previous day. The bulls really sent the shares rising a little bit higher. In this case, if you're looking at assets and you see a bullish engulfing pattern, so let's get an example from the chart here, and then we'll be able to show a couple in action. Okay, so look at the engulfing patterns occurring here. We get a bearish engulfing first, as shown here, and that's in the downtrend, signaling the market still has further to drop. Then we get a bullish engulfing here, right at the bottom of the price data, and that is accurately warning of a reversal, this time to the upside instead of to the downside from before. And then we get another bearish engulfing here, partway through the subsequent uptrend, which marks just a minor interruption to the trend. Nevertheless, there would still be a trade between this 840 point and roughly 820, and with leverage, we mustn't complain about the potential benefits at all. So the next chart pattern we're going to be looking at is an evening star. This is a bearish pattern that comprises of 3 candlesticks, the first of which should be a reasonably strong white candle, as shown here. The second should open with a gap up. It doesn't matter though if it is white or black in terms of color. The color of this second candle is insignificant. The third candle though must open with a gap down and be a strong bearish candle. It's showing a strong U-turn in sentiment. Think of it in terms of things being a little upside down, in terms of a representation of a U. That's how it shows itself to be a bearish reversal pattern. The wicks in this pattern are of no relevance. The candles may or may not have wicks, but hey, let's look at an example in practice. In this case, we've got an evening star pattern marking a beginning of a secondary retracement on the Russell 2000 index. You can see here, you've got your pattern, and then you've got a subsequent fall in the price of the asset afterwards. Now let's look at a morning star. This is essentially the bullish counterpart of the evening star. It begins with a strong black candle here, then a small bodied second candle, of which opens with a gap down. You can see this is the opening point. That was a gap down from there to there. The final candle though is a strong white candle that gaps up on the open. You can see between the previous close on the second candle here and the opening price on the third. That area is where the gap has been created. Now that gap up has happened on open. Again though, wicks are not important, and neither is the color of the second candle. But how would this work in an example? We've got one here, an example of a morning star correctly notifying chart watchers of a reversal. Interestingly though, one personal observation is that it occurred at the thrust measurement price level, which was obtained from a symmetrical triangle here that just formed before. If you're not familiar with chart patterns or the minimum price projections associated with them, consider watching our videos on chart patterns. We've got a lot on our site and YouTube, and feel free to just see them. Maybe that will help understand this area if you haven't been familiar. If you are, then this is an interesting point to make there. But for now, just try to get to the grips with candlestick patterns. So we've got our example. We can move on to the next pattern. This is a bearish Harami. Now, Harami patterns are the opposite of engulfing patterns. For a bearish Harami, the first candle is white and the second fits entirely into the real body of the first candle. Therefore, it must open with a small gap down. The color of the second candle, however, is not significant. Look at the first one, second one could still be up, doesn't matter, but it has to be engulfed essentially. So let's look at an example in practice of this bearish Harami. Here's a quite interesting chart in my opinion. We've got a resistance level that was established early in the chart. We can see this area, and we can see an opportunity after a bit of price action to retest this level one more time. It looks that the price is actually able to break out, but the very next candle forms a bearish Harami. By fitting with the previous range, you can see this one fits right into that one. The second one fits right into the first one. This is a bearish pattern, and its warning of weakness is showing itself in the breakout, letting you know that it's likely to be a false breakout. The bullish momentum required to sustain a breakout rally just wasn't there. The next candle was a strong bearish Marubozu though, and this kicks off a strong decline in price. Look at that one there. This is the bearish Marubozu, a breakdown, and then you see a subsequent fall in the price of Facebook shares. Notice also that the second candle of the Harami was also a bearish shooting star. So now we're going to look at a bullish Harami. This occurs after a decline in prices, and the first candle should always be black. It should be a down candle. The second candle fits within the first candle's range and may be black or white. Once again, like the bearish Harami, that part is similar. It doesn't matter whether this bit is up or down as long as it is within the full body area. So let's look at an example in practice. We've got an example of a bullish Harami accurately identifying the resistance used to trigger a reversal. The first candle is a bearish Marubozu here, a huge hit to the valuation of shares for Facebook. The first candle, being that bearish Marubozu, is followed by a small candle which fits very well into the Marubozu. And this support is tested briefly, we can see here. And then a rally, well, this is where we get that first bit, and then we have where the support is tested, and then the rally unfolds after that. We've got another pattern called three black crows. This is essentially an intrinsically bearish pattern. It consists of three consecutive strong black candles. They may or may not have wicks. That part doesn't matter. It is considered, though, that an even stronger bearish signal can be seen if the three candles overlap, such as shown here in the diagram. But that is not strictly required. It can still be classified as a three black crows setup if they do not overlap. You see this a lot of the time across stocks when they give, well, companies when they give profit warnings. You see these huge three black crows setups of where you have serious reversals in the valuations of different asset prices. So here's an example in context. Here we can observe the three black crows pattern marking the beginning of a large reversal of an uptrend in India's Nifty 50 index. You can see three black crows and an ugly reversal in that index valuation follows this subsequently after this pattern has been formed. Let's look at the reverse, the three white soldiers setup. Here, this is the final pattern of this entire video that we're going to go through. 3 white soldiers. This comprises of 3 strong white candles, which may or may not have wicks. And again, as we mentioned with the 3 black crows, it is a stronger signal if the candles overlap, but this is not a requirement at all. So let's get an example in practice here. So here we can see a 3 white soldiers pattern showing a new bullish sentiment in the Nifty 50, a sentiment which persists for a prolonged uptrend. So to conclude this very long video, we've been through 19 candlestick patterns and how you can interpret them to get a sound insight into the collective sentiment of market participants is up to you. It's unlikely that you'll remember them all after watching this video, so use it as a reference when you can come back to it at any time you desire and practice getting used to recognizing them in real market scenarios. Note that in some markets, some candlestick patterns will take on a slightly different shape. In foreign exchange markets, for example, patterns which include gaps, such as the evening star, will occur without the price gapping, and this is because you've got extremely high levels of relevant liquidity on these foreign exchange markets. But in some small cap indexes, you won't likely see that issue occurring. You'll see gaps occurring, huge price gaps, whether up or down, it doesn't matter. But remember that you can greatly increase the effectiveness of using candlesticks by looking for occasions where the intrinsic sentiment of the candle pattern is corroborated together by the intrinsic sentiment, or where the pattern occurs. The macro context, should we say, in terms of technical analysis. Now, candlesticks can be really useful as confirmations when combined with other analysis methods, and can work particularly well with other technical tools which act as price barriers like trend lines, moving averages, or support and resistance. So before you finish watching this, it might be a good idea to consider checking out those videos too.